I know that you've been waiting a long time. Your dad's been waiting a long time. I've been waiting a long time. And so is everybody listening for rates to finally come down. Where do you see us going here in the short term? I'm not going to ask you to predict out a year from now because that could be even more difficult. But over, say, the next 90, 120 days, something like that, what do we need to be looking out for? Where are you guys forecasting rates to go? And I want to give you a lot of grace because I know that this stuff is difficult to predict.
Yeah, I mean, Yogi Berra said it. He said, predictions are tough, especially about the future. But listen, it's not easy to put your thoughts out there because, of course, they can be wrong. But I think as long as you have some good reasoning and really why you're formulating that decision, I think that that's important, right? So nobody knows for sure what's going to happen, but there's certain things that we know are going to be the biggest influences on the market and specifically on mortgage rates. And those are inflation, the labor market, and the Federal Reserve. Now, of course, there's other ones out there, but those are really, in my opinion, some of the main drivers. Of course, there's X factors out there. We don't know if President Trump is going to institute some or all of these tariffs, or if it's just a negotiating, thing that appears to be working in some scenarios. Because, if there is a lot of tariffs instituted, well, that could change the picture on inflation. But based on what we know today, I think that we're going to see inflation start to move lower this year. And I think one of the reasons for that is we're finally seeing the biggest component of the inflation reports that we get, which is shelter. That's rent, owner's equivalent rent. We're finally seeing signs that it is catching up, meaning it's been lagging behind. It's been overstating inflation because the numbers are much higher than what they are in reality, looking at more real-time sources. And it has to do with the way they calculate the data. They look at panels every 6 months. It takes a very long time for the new rents to filter in. So the bottom line is this. We're seeing the shelter, biggest component, showing signs of catching up, which when you have the biggest component that's now starting to come in lower, it makes it easier for inflation to come down. Also, the mechanics of it in the first quarter of the year, when you look at these year over year numbers, which is what everybody looks at, remember, the Fed wants to see 2% inflation year over year. That means they want to see prices of goods and services going up at 2%. Now, it's important to note that that still means prices are rising, just at a more manageable pace, and it's decelerated from some of the high inflation readings that we were getting. So the thing is when you get a new report, so on the 30th, or I should say on this Friday, right? So that's going to be the 31st. We're going to be getting PCE, personal consumption expenditures. That's the Fed's favorite measure of inflation. That's the one that they're benchmarking to 2%. Well, when you get the new reading, which is going to be for the month of December, what happens is the December reading from 2023 will fall off and it gets replaced with the new reading. So the numbers that you're replacing can be important. If you're replacing a low number, even if you get a modest reading, it's hard to make progress. If you're replacing a higher number, it makes it easier to make progress on year over year inflation. So you have shelter as one thing that helps. But the other thing is in the first quarter, you really start to see some of those replacement values from the previous year be a lot higher. And that makes it a higher probability that you can make progress on inflation. So from an inflation standpoint, we believe it's going to come down this year. I think over the next few months, we have a chance to see it coming down a decent amount that can help mortgage rates. From the labor market perspective, which is also critically important, we've been seeing the BLS, the Bureau of Labor Statistics, who releases the monthly jobs report, and it's one of the biggest influences on the market. And those of you that have been following along, you know that, over the last year, we've been seeing strong jobs report after strong jobs report. And then when that's released, the bond market doesn't like it and mortgage rates move higher. But the issue is that because of the way they are calculating their data, it's an overstatement on a consistent basis, meaning they report a very high job creation number, and then in the subsequent 2 months, they revise it substantially lower. But the market cares most about when it's released, and it doesn't react as much to those revisions, but it can be frustrating because if they came out with the right number initially, we'd see mortgage rates much lower than they are today. So it does eventually catch up. And there's something called the QCEW, Quarterly Census of Employment and Wages. It's also released by the BLS, but it's the actual data. You see, the monthly report that they put out, they sample 670,000 businesses. They use modeling. But then the QCEW, it comes out much later. It's the actual data. It's essentially revising what they did in the previous year. And in February, we'll be getting the new QCEW data, which is going to show you from Q3 of 2023 to Q3 of 2024. So it is a little bit older, but preliminary estimates are expecting that instead of seeing 2.5 million jobs created, like the BLS reported, we're going to see 1.255. So essentially, it means that we could see half or 50% of the jobs that we thought happened didn't actually happen because of issues that they have with the way that they're putting these numbers together. And I think that's something that the market really won't be able to ignore. So I do think the labor market is not as strong as some of the published data shows. You look at all these surveys, and consumers certainly aren't feeling as strong as those reports show. We know that they're overstated and revised. I think this QCW report's going to be big for the market. I don't think the Fed will be able to ignore that. And listen, the unemployment rate right now is 4.1%. Now, the Fed has told us through their summary of economic projections that, boy, if it goes to 4.4%, well, that's only 0.3 higher than where it is right now. Then you're going to have 14 of the 19 Fed members surprised because based on their forecast for where the unemployment rate would be, 14 of them had it below that. And then if it goes to like 4.5, 4.6%, all 19 Fed members will be surprised. So even though at the December 18th meeting, the Fed took away projected rate cuts from this year, 2025. They took 2 of them away. Initially, they were forecasting 4 rate cuts. Now they're only forecasting 2. I think they can change their tune very, very quickly. If you see inflation come down, you start to see some weakness in the labor market. I would not be surprised if, after all, the Fed ends up cutting 4 times in 2025. So I think inflation is coming down. I think the labor market is going to be a little bit weaker. And I think that we're going to see the Fed end up being more accommodative and removing more restriction than they said at the December 18th meeting. You put all this together, I think we will see mortgage rates trending lower. And, it's always hard to put a number on things, but, we did release a pretty in-detailed forecast at MBS Highway for this year. And we think there's a good chance that sometime this year, you could see mortgage rates in the high 5s or low 6s. And listen, we saw that happen back in September. And we saw a ton of activity, right? We saw a lot of refis. We saw a lot of purchases. So we know the demand's there. And if we can get back down to some of those levels, I think it will be meaningful for everybody's business.